Well, investors are getting a bit of a breather today as markets bounce back up, but our next guest says he expects more volatility in 2025, and he says the markets of late can make even professional money managers look like amateurs. Let's find out exactly what that means. Joining me from Winnipeg is Grant White. He's portfolio manager and investment advisor at IA Private Wealth. Grant, thanks a lot for joining us. How are you, what are you telling your clients, let's say, through this period of volatility when they see markets in correction territory, as the NASDAQ is, and the S&P 500, for all intents and purposes, is as well? What kind of questions are they asking, and what kind of answers are you providing?
Well, I think that you hit it on the head there, Paul, which is that, these markets are very predatory right now, and they're very good at shaking out even the best investors and making them look like amateurs, as I said. I think that's what investors need to keep in mind right now, is that these are somewhat dangerous markets right now. But what I'm telling investors is, if I could tell you, if we could look back 5 years ago, and if I told you there was going to be a global pandemic, there was going to be wars in Europe, there was going to be, you name it, all of these different events that we've seen over the last 5 years, and that markets would still double over that period of time, or in the US and in some cases, and then up over 60% you think here in Canada over that same period. I don't think anybody would have believed that. But that's kind of like how these markets work. And so that's what I'm reminding of investors of, is that, yeah, there's going to be volatility. I think there's going to be a lot of volatility this year. I mean, obviously there's plans in the United States, and those are going to impact everybody. And I think they've got the opportunity, if you will, this year to make all those things happen. And that's going to cause some shockwaves. So investors need to be very careful. They need to not give in to the emotional challenges that we're all facing. We feel it. I feel it too. But we're just reminding people that, if you stick to high quality and a disciplined approach, you're going to do really well during these markets, and look for opportunities, because we're starting to find them.
How do you think North American investors should be thinking about the European stock market, which is now breaking record highs and is leading the developed market world? I think it's safe to say most Canadian investors don't have huge sections of their portfolios devoted to Europe. They've got Canada, they've got US, and that's largely it, I think, for many Canadian investors. How should they be thinking about those European stocks?
Well, I think that's a great point, Paul, because I think, as you know, and as we all know, that most Canadian investors are too Canadian-centric, and probably most North Americans are too North American-centric. And, we've been, it's been our strategy to be more globally diversified for a long time now. And it's simply because there are other opportunities in the world that we often ignore. Yeah, the best opportunities might still be in the United States, but there's so many good opportunities out there still in places like Europe and other developed markets across the world. And so, I'm not surprised to be seeing that at all. And in fact, we've been allocating funds there for some time. But I do think investors need to open up their minds to it, because, as we're seeing right now, there is lots of good opportunities. There's other parts of the world that are very interesting as well. And I think if you want to navigate through the volatility that we're going to continue to experience, you're going to have to open up your mind to other ideas that are available elsewhere in the world.
Okay, what sectors of the Canadian market do you like right now? The Canadian market, as measured by the TSX, which is a blunt instrument, to be sure, a blunt index. But what segments of the Canadian market do you like best?
I still really like energy. I mean, I think that the reality is we know the demand for energy is going higher. I think there's going to be some interesting things coming out, especially if we can end this war in Ukraine, in any time soon. That would be obviously a good thing for the world, but I think that's going to play some interesting roles for energy, and that will impact Canadian companies as well. But I still really like Canadian energy. I think that we have some fantastic businesses here that are going to do well. C&Q is probably our #1 pick in that area. We love the company. We think that they can do really well, even at lower energy prices. We've seen that in the past. They've got a strong, stable dividend. The company continues to grow at a healthy rate, and I think they're so well managed. And so we still really like that company. Whitecap is one that's obviously had a bit of some waves lately after recent earnings and the acquisition. And still, Whitecap is still a company. I think we've been picking up some shares. We've owned it for a number of years now, and we're starting to pick up some shares in that company as well. And as prices potentially come down and we see more buying opportunities, we'll continue to buy both of those companies.
I know Netflix is a stock you like. We can put it up on the screen and show viewers what has happened to Netflix over this period of volatility. It has, and there you see it, it's off its high, certainly. trading now at $917. What the company's done recently in terms of results has recorded a string of almost unbelievable subscriber addition numbers. You continue to like this story.
Yeah, I'm liking this story more and more. And I think that Netflix actually has proven to be such an adaptable company. I mean, they've shown that throughout their history, but they're continuing to show it today. And we're seeing that in live sporting events and live like wrestling and things like that. They're really starting to pick up steam in those areas. And they're bringing in a new user base. They're bringing in a new customer base that possibly wasn't there before. And that's why I think we're seeing these big pickups in their active users. And so I think Netflix is going to continue to do well in this space. It's a company that we want to pick up again on dips. It's obviously a company that's very well known. It's had great years over the last decade or so. And so, we want to be careful on pricing, but we strongly believe in the management and we love their adaptability. And I think they're going to do quite well still going forward.
Okay, let's talk about Costco, another very highly regarded stock. Its management and execution almost universally praised. The issue on Costco from an investor point of view and a portfolio manager point of view has typically been its valuation. It's also become a lot cheaper quite recently. What do you think of Costco after this recent decline?
Well, that's one of the big reasons why it's become interesting, right? Is because the pricing has come down into a territory where it's like, yeah, we always knew it was a good company. Everybody knows it's a good company. And so when the pricing becomes attractive, then it gives you that opportunity to look into it. One thing I really like about Costco through this particular environment is that we think they can navigate the tariffs very, very well. They've already come out and said that, they're going to be working with their suppliers to try to have them take on the majority of the tariff and taxes, basically, versus their consumer base or their customer base. And so that is really interesting, the pricing power that Costco might have there. But on top of that, they also have suppliers. They think they can navigate the tariffs by just changing the suppliers to other jurisdictions, depending on where they're selling. And so I think Costco is just a fantastic business overall, and the fact that they have that type of ability to do so just screams that they should be able to do well. Now, we think they can do well in tough economic times because, obviously they can be that low cost seller, especially on things like groceries, et cetera. But at the same time, if things are going well, we know people are going to buy more patio furniture and other things like that from them as well. So I think that actually they're a really good hedge to this market volatility that we're seeing. And I think if you can pick it up on good pricing like we're seeing right now, this is a company that you can hold for a very long time, maybe forever.
Grant, thank you so much for joining us as always. Grant White, portfolio manager and